Pull up your home insurance bill. Somewhere on it, there may be a charge that didn't exist last year. It's not a rate hike. It's not a fee you agreed to. It's the bill for the Palisades fire, landing on homes hundreds of miles from the burn zone. Homes that never saw smoke. And just weeks ago, a judge ruled it's perfectly legal. That charge comes from a 57-year-old system most Californians have never heard of, quietly wired into every home insurance policy in the state. It's a big part of why average premiums here are up roughly 84% since 2020. Stay with me, because by the end of this video, you'll know exactly where your money's going and why the next bill will be bigger. January 7th, 2025. 2 fires ignite on opposite sides of Los Angeles. One in Pacific Palisades, one above Altadena. By the time they're contained, more than 16,000 homes and buildings gone. Roughly 150,000 people forced to evacuate. Then comes the second disaster, the financial one. Within a year, insurers pay out more than $22 billion in claims. But buried in that number is a detail most people missed. Thousands of those destroyed homes weren't covered by normal insurance companies at all. They were covered by the state's insurer of last resort, a shared pool holding the policies nobody else wanted, stacked in exactly the neighborhoods that burned. That pool took an estimated $4 billion in losses. It did not have $4 billion. What happened next is the reason your bill went up. Even if you've never seen a wildfire in your life. The system is called the FAIR Plan. Fair access to insurance requirements. First twist. It wasn't built for wildfires. It was born in 1968, after the urban riots of the 60s, when insurers abandoned entire city neighborhoods and lawmakers forced the industry to sell basic fire coverage anyway. Get this straight because it matters later. The FAIR Plan is not a government program, not one taxpayer dollar. It's a private pool that every licensed property insurer in California is required to join. The industry's shared safety net. If nobody else will insure you, the FAIR Plan has to. But the coverage is bare bones. Fire and smoke, and not much else. No theft, no flood, no liability. It usually costs more and covers less. Nobody chooses the FAIR Plan. You end up there. And Californians have been ending up there at a staggering rate. 2022, roughly 270,000 policies. Today, more than 680,000, about 5% of the homes in the state, up from less than 2% in 2020. The backup plan was quietly becoming the main plan. Then the fires hit it dead center and exposed the machine at the heart of this story. Here's how the machine works. Call it the pass-through loop. Step 1. Wildfires make risky homes unprofitable, so private insurers drop them. Step 2. Those homeowners land on the FAIR Plan, concentrating the state's worst fire risk into one thinly funded pool. Step 3. A catastrophe hits that pool. And Step 4 is the part almost nobody knew until 2025. When the FAIR Plan runs out of money, it doesn't go bankrupt. It sends the bill to every insurance company in California, and they're allowed to send part of it to you. February 2025. 1 month after the fires, regulators approve a $1 billion emergency assessment on the state's insurers. The insurers get permission to claw half of it back from their own customers as a surcharge. Over $420 million approved so far. That's the mystery charge on those renewal letters. Consumer groups sued, arguing the industry should eat the whole bill. In June 2026, a Los Angeles judge ruled against them. The surcharges survived. Round 1. They're weighing an appeal. But while the lawyers fight, the charge stays on your bill, and the loop keeps spinning. Assessments and reinsurance costs get baked into everyone's rates. Premiums up about 84% since 2020. Typical deductibles up from around $1,800 to over $2,500. Higher prices push more people out of the private market, which swells the FAIR plan, which makes the next assessment bigger. That's the trap. The backstop has become the pipe, spreading every disaster's cost across the entire state. And inside the burn zones, the math is brutal. Average sale prices in Pacific Palisades: $3.6 million before the fire, $2.4 million by late 2025. Altadena, down more than 60%. Investors have been buying roughly 40% of fire zone properties, often from families too underinsured to rebuild. 1 year after the fires, about 2,600 rebuilding permits had been issued, against more than 16,000 destroyed structures. The fire decided which houses burned. The insurance math is deciding who comes back. So is the FAIR plan the villain? Consumer advocates say no. Without it, hundreds of thousands of Californians couldn't get covered at all. No coverage, no mortgage, no home. Insurers call it a Band-Aid, hiding the real problem. Decades of building in places that burn, with premiums held artificially low the whole time. Regulators are now offering the industry a trade. Use your modern catastrophe models. Charge for your reinsurance, things California blocked for decades. But in exchange, you commit to actually writing policies in high-risk areas again. It's starting to work. Slowly. In April 2026, Travelers became the first top 10 insurer since the fires to commit to expanding in California under the new rules. Here's my take. The FAIR plan isn't the disease, it's the fever. That surcharge is the moment California's wildfire risk stopped being someone else's problem and became a line item on every policy in the state. Call it an outrage or call it insurance doing exactly what insurance is supposed to do, spreading catastrophic risk across everyone. Which one you pick probably depends on which end of the state you're standing in. So here's where you stand. The Palisades fire didn't break California's insurance system. It revealed a system that was already cracking, then handed the whole state a piece of the bill. And here's the part that should keep you watching the horizon. Nothing about the loop has changed. The FAIR plan is still adding policies. The pass-through is now court-tested, and so far it's winning. Which means the $1 billion assessment wasn't really the bill. It was the receipt for one fire season, with the machine already loaded for the next one. The only open question is how big the next line item gets. If you're a California homeowner wondering what your options are, check the links in the description. Resources on the FAIR plan, home hardening discounts, and how to shop the market as insurers come back. This is not financial advice, and please do your own due diligence. Now pick a side in the comments. Should a homeowner in Sacramento who's never seen a wildfire help rebuild multi-million-dollar homes in Pacific Palisades? Or is spreading the risk exactly what insurance is for? And subscribe, because when the next assessment lands, you'll want to know what's on your bill before your insurer tells you.